Guys, I did a video almost 2 years ago in February 2021 saying that even if Tesla had 100% of the global car market in 2030, the stock price was still overvalued at the time. Well, since then, they doubled the amount of cars they sell from about 500,000 to about 1 million a year, and their profits are up about 14 times from where they were in the video. So, why is the stock price down about 40% from that video? And has Tesla gotten cheap enough that it is relatively a good buy at these levels compared to other car makers? Let's take a look. So here is a look at the Tesla chart. This is split adjusted prices, and back in February 2021, it was about $270, and the earnings per share were about 25 cents. Now they are about $3.60, so about 14 times higher in earnings back when the stock was over here. And like I said, they sell twice as many cars. So why is their stock price down about 40% from this high over here when they are now making a lot more profits and selling a lot more cars? Of course, the answer is this. This red line is the PE ratio. And at the time, the PE ratio was about 1165. Compare that with most other car makers, which are between like 8 and 15 PE. And Tesla now has a PE, according to this chart, of 58, or according to Yahoo, more like 35. So this PE has come down by a factor of about 30 times. So this is how you could be right about a stock's growth rate and how much more they're going to sell in a few years, but still be wrong about the stock price because you are overlooking the PE. You are over euphoric about the growth rate of the company, and the growth rate eventually comes down even if their sales and profits go up. And so what you're looking at is a lower stock price, even though everything is a lot better than it was 2 years ago. And so to illustrate why the price to earnings ratio of a stock is so important, I have this graphic here that represents the worldwide car market, let's say, and it's represented by the big three plus Tesla, right? So Toyota, Volkswagen, and GM. So let's pretend that these apartment buildings represent how many cars each of these sell. So this Toyota is a 10-floor apartment building, meaning that every floor represents 1 million car sales, right? So they sell 10 million a year, VW 9 million, GM 7, and Tesla 1. And let's assume this is the whole worldwide car market or the worldwide apartment market, right? So for every floor that Toyota has, let's say these are representing 1 million apartments, right? So they are renting out 10 million apartments a year, and Tesla is only renting out 1 million apartments a year. However, their story is that, yes, we are only renting 1 million apartments a year right now, but we are going to grow so high that we're going to grow higher than all three of these combined, or at least take so much market share from these companies that our building is going to be 15 or 20 stories high. And so in the future, we're going to get all of this money. But let's see how these buildings are valued, right? The market cap, meaning all of the stock in Toyota times the current stock price, is the market cap. So you can buy this Toyota building for $187 billion. Let's say you bought all the stock and you own this whole building. How much money would you get in profit a year? Well, you would get about $18.7 billion a year in profit from renting this all out after expenses. That's a PE ratio of 10. So what that means is if you paid $187 billion and held this building for 10 years, you would get back your purchase price in 10 years because it has a PE of 10. You're getting $18.7 billion a year in earnings. Similar for Volkswagen, same thing. You would pay $78 billion for this 9-story building, it would pay you 17 billion in earnings, and it would only take you 4.5 years to make your money back if you bought this building. GM, you pay 47 billion, you make 8 billion a year. It takes about 6 years to make your money back from this 7-story building. Now we come to Tesla. For this building, they want you to pay $344 billion. That's more than all these 3 buildings combined. And they only make $10 billion in profits after they rent it out and their expenses and everything like that. And so at the current PE ratio, this would take you 34 years to make your money back, which sounds like a lot, but it is an absolute bargain now compared to where it was 2 years ago when the PE was 1160, which means it would take you 1160 years to make your money back if you bought this Tesla building or Tesla stock. So why did so many people believe in Tesla when they had a PE of 1160? Because one, the stimulus euphoria, the bull market and all of that, but they believed that this Tesla apartment is way better and nicer than these apartments, right? It's newer, it has a newer electrical system and heating or whatever. And so these are old, stodgy apartments. Maybe they're going to start renovating these a little at a time, meaning they're going to start making electric vehicles eventually and possibly catch up. But they believe that Tesla was just going to keep growing forever. But here is the fallacy in that theory. So in this example, they're making $10 in profits for every floor of apartments that they have. Well, Toyota is only getting $1.8 in profits per floor. They got 10 floors, they're making 18.7. GM is similar. They're making about 1.7 or something like that per floor. So why are they making so little money? Because this is a low margin business and not everybody can afford an expensive Tesla, just like not everybody can afford a Ferrari if they wanted to. So all of these people that live in these cheaper apartments, so to speak, maybe some of them would like to live in the Tesla building, but it's 5 times more expensive than the building they're living in now. So Tesla cannot grow to these levels and take all of these customers away without selling a cheaper product, which means cheaper margins along the way, which means less profits as they get bigger and bigger, so that they start to resemble the big guys here, and their price to earnings ratio starts to resemble the big guys. And so the reason people suspended disbelief and thought Tesla would grow forever and make really fat margins forever is represented in a chart like this. This is the investment cycle chart, and you could think of it as like the Tesla stock chart. It looks very similar, doesn't it? So you could think of it as different levels of investors at different stock prices. So the first level of investors are maybe people that run mutual funds or whatever, and they say, yeah, it's pretty cheap and it looks like it could do okay, and we're going to buy some. And then maybe some early investors, people that bought the car and really liked it, they start to buy it. Then you start to get media attention. Then you start to get stimulus, then you start to get enthusiasm, and then you start to get greed, and then you start to get delusion and the new paradigm. And what's the new paradigm? The new paradigm is, no, you're mistaken. This cannot be compared to a car company like Toyota, because it's not a car company, it's a new paradigm, it's a technology company. They don't just build cars, they build cars that goes and does Uber rides while you're at home sleeping, right? The self-driving is going to go drive around. It's actually going to make you money. It's going to be the first robot fleet of Uber kind of taxis making you money and all kinds of stuff. So the growth potential was limitless up here. And this is where most stocks usually run out of steam, and then they have a drop and another pop up, and people think, okay, this is just going to go to new highs from here. and it doesn't. And then people start to get worried. People start to second guess. There's not as many people here saying that this is no longer a car company, this is a technology company. There's no longer so many people here being so adamant that in a year, there's not so many people that are so adamant and sure that your car will be self-driving and doing Uber rides while you're home sleeping over here. And so it gets to the point of capitulation and then despair, right? And in my mind, I think we are somewhere a little bit past the fear and not yet capitulation, but we're probably close to it. So I wouldn't be surprised if it goes down maybe to 80 or 60 in a big flush down, and then probably bounces back from there somewhere around those levels. Now, this kind of thing played out during the internet bubble, and Cisco Systems was the Tesla of the time. They were the leaders in routers that were powering the internet, and the internet had unlimited growth ahead of it, and everybody knew all you had to do was just close your eyes and buy Cisco, and you will continue to get rich. Now you see here around the top, August of 2000, the price was about $66. Their earnings per share were about 38 cents, and their PE ratio was, so 170 PE is pretty cheap compared to Tesla's 1160 PE. But anyway, fast forward 22 years later, and where are we? Well, the stock price is about $16 cheaper than it was 20 years ago, but the earnings are 2.8, so about 7 times more earnings than in 2000. But the PE is back to 16, which is approximately where the S&P trades, somewhere between 18, 20, 16, something like that. So this shows that you could be right about the growth prospects for a company, but if you overpay for it, then it won't matter, because those growth projections could pan out like they did with Cisco, but they will return to a more normal PE eventually, because companies don't grow forever and trees don't grow to the sky. So guys, that's why it is real important to pay attention to the price to earnings ratio, or the valuation of what you pay for a stock. As you see at the top of the market, Tesla had a PE of like 1160, and everybody was making up all kinds of excuses of why that didn't matter and why it is different this time. Now, one thing to also notice is that all the analysts were super bullish on Tesla at the time, because everybody is overly optimistic at the top. And now we're seeing the opposite, because everybody is overly pessimistic at the bottom, and I'm already seeing articles saying that Tesla could go to $30. And by the way, that same person who said that was bullish on Tesla a year ago. So Tesla is a little still expensive, but it could have a nice bounce. Also, Elon Musk may publicly focus more attention on Tesla now that the stock is dropping, and actually give away the CEO title of Twitter to somebody else. If he did that, that would probably ease a lot of investors' minds and make Tesla pop a little bit, I would think. Still, Tesla is a little bit pricey compared to other car manufacturers, and is facing more and more competition every day. Also, it is a different time now. The 2021 stimulus party is over, and everybody has a hangover from looking at their brokerage account balances this year. So yes, it is still overpriced, but due for a bounce, especially in the new year after people sell it to realize tax losses this year. But the days of limitless euphoria and Elon worship seem to have come to an end for now, and Tesla will trend towards being priced like a regular car company rather than a magical unicorn company. Also, remember that the leaders in the last bull market are usually not the same leaders in the next bull market. As always, it's your money, so make your own decisions, and let me know in the comments if you think it has gotten cheap enough, or if there is still some room for it to drop some more. If you want to see the Tesla video from 2021, you can see it here.